Hi guys. Today we will analyze JM Smucker stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Compared to the overall market, the stock is an average performer. The long and short-term trends are both positive. Support levels are around $136 and $129. Next support levels are around $123 and $119. Resistance level is around $145. In the last month the stock has been trading between $127 and $140.70 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 0.8 million. This is not a very liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 1% per year, for last 5 years. We see that the average profit margin of the stock has been around 11% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 120% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Smuckers Company: bad, average, and good. First scenario. Smuckers will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 0%. Future profit margin would be low, 6%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $91. Second scenario. Smuckers will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 1%. Future profit margin would be average, 6.5%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $114. Third scenario. Smuckers will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 2%. Future profit margin would be high, 7%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $141. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.31. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Smuckers, analysts forecast growth rate around 2% per year in next 5 years, and future P/E around 16. Again, I will use 3 different scenarios for Smuckers Company: bad, average, and good. First scenario. Smuckers will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 0%. Future P/E would be low, 16. In this case, the fair value of the stock today would be $36. Second scenario. Smuckers will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 1%. Future P/E would be average, 19. In this case, the fair value of the stock today would be $47. Third scenario. Smuckers will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 22. In this case, the fair value of the stock today would be $59. As you can see, today the stock is overvalued, $139, even if we expect the company's high performance in future. The company has no moat. And the fundamentals are weak. And the stock is expected to show a very small growth, 1 to 2% per year, in the next 5 years. Based on that, the stock looks expensive at current levels. High debt. No moat. Very slow future growth. The stock's fair price today is around $100. I'm not interested in buying this stock. I may reassess the stock in 2023 though. Company's strengths. The J.M. Smucker is a leading American manufacturer of food and beverage products. Its primary products include coffee, peanut butter, fruit spreads, pet food, and pet snacks. Major brands include Folgers, Dunkin Donuts, Jif, Smuckers, and other. The company has offset inflation and supply chain challenges with price hikes and improved productivity. Smucker's sales trajectory should improve over time, due to the divestiture of slow-growing brands and the increasing mix of Uncrustables, which grows at a double-digit pace. During the pandemic, consumers adopted 11 million pets, and purchased 3 million coffee machines, which should provide a lasting benefit for categories representing nearly 70% of Smucker's fiscal 2021 sales. The company is a dividend aristocrat with 25 consecutive years of dividend growth. Shares currently yield 2.83% per year. The company has a return on assets of 3.6%, this is better than the industry average of 1.5%. Its profit margin of 7% is better than the industry average of 2%. Risks. The company has been one of the major beneficiaries of the pandemic-induced tailwinds for non-perishable foods. However, the company is now faced with a falling return on tangible assets, and risk of further margin compression. It needs to find a path to growth through reinvesting in its current brands, or seeking out acquisitions. The largest segment of pet foods is also feeling the pressure, at a time when major peers flourish. The company faces significant commodity price risk. It requires large quantities of agricultural products and other commodities, whose costs may fluctuate due to weather, natural disasters, political unrest, and other situations beyond the company's control. Smuckers uses a single national broker to sell many of its products to retail grocers, and sales could be hurt if this broker fails to adequately represent the company. Smuckers has faced frequent product recalls in its consumer foods and pet foods divisions, due in part to its failure to control vendor relationships. The company's return on equity of 7% is worse than the rest of the industry. The industry average return on equity is 10%. High debt level. The company's net debt to equity ratio, 50%, is considered high. Based on estimates for the next 5 years, the company will show a very small growth in earnings per share. The EPS will grow by 2 to 4% on average per year. The revenue is expected to grow by only 1 to 2% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.